The yield curve historically has been the best leading indicator of recession known to man. It's only had one false positive ever, which makes it the doomsayer of detriment, the predictor of peril, and the harbinger of havoc. But 2/3 of all financial strategists polled by Reuters said that it's different this time. Isn't that comforting to hear? Let me back up. What is a yield curve? The yield curve is just a graph. It shows you how much money you're going to make on the y-axis based on if you bought bonds today at various lengths on the x-axis. Now, obviously, if you buy a 2-year bond, your yield is going to be roughly twice of that of a 1-year bond, but it's shown annually. So why does this graph just magically signal recession? Well, it's kind of a complex question. You kind of have to understand the way that bonds fit into the context of our financial system to really answer it. Bonds are a source of protection. It's a source of safety, as opposed to a stock where you buy a stock and you get what you get, you don't throw a fit. A bond is an agreement. You have a pledge to be paid back the specified amount, and you know what you're getting into. You're going to get exactly what you signed up for if you hold it to the end. Because of that, bonds aren't nearly as risky as stocks are. If a company goes bankrupt, they are legally obligated to pay the bondholders. The same is not true for stockholders. You don't get anything in most cases. The interest rate that you're going to make on a bond is determined by how much you can buy it at. If you buy a bond for $95 and you get paid back $100, that's about a 5% return. And the rates are determined by the supply and the demand in the bond market. There's buyers and there's sellers, and the price goes up and down just like stocks. But the difference is that the biggest determinant is the Federal Reserve. The Federal Reserve sets the overnight bank lending rate, which then kind of determines, okay, how much are banks willing to give CDs for? How much are mortgage issuers willing to accept in interest rates? And so that determines the rate of the bonds, because people say, okay, well, if banks are giving each other 5% annualized to hold it for one day, I should probably get a little bit more if I'm holding it for a month or a year. So the Fed basically has this one lever, and they can pull it to have a very big rippling influence on other parts of the market. But you can see why the interaction between the price of a bond and the interest rate thereof would be inversely correlated, right? If you buy a bond for very cheap and you get paid back very much, that's a high interest rate for a low price. I want you to think about this though. If you are looking to buy a bond and everybody else is buying 1-year bonds for 5%, that's the interest rate they're getting, what would you expect the 2-year bond to be? Would you expect that annual interest rate to be more or less than 5%? Well, almost unanimously, the answer is more, right? If you're locking your money up for a longer period of time, you want to be paid more for that. And this is called in finance the liquidity preference theory. In my opinion, it's not really a theory. It's kind of a fact of life. People would rather not have their money locked up if given the choice. But this leads to the idea of a liquidity premium, right? If you're going to lock it up for more, you should be paid more. That makes sense. So if you think about a yield curve and you're looking on the very far end, 30 years, you'd expect that annual return for locking your money up for 30 years to be quite a bit more than the annual return for locking your money up for 1 month, right? You'd expect that this yield curve would have this upward sloping shape to it. And that's exactly the typical form of a yield curve, hence the term yield curve inversion. This is different. Yield curve inversion is when either the yield curve is completely flat, meaning there is no premium for buying a long-term bond as opposed to a short-term bond, or when the yield curve is downward sloping, meaning that 30-year bonds you actually get paid less, or any of the combinations in between. Anything that's not an upward sloping curve, it can be classified as an inverted yield curve. So back to the central question of why does the yield curve signal recession, right? If you think that the economy is about to go take a harsh dive, the Federal Reserve is probably going to have to cut interest rates in order to stimulate spending. When they cut rates, people are going to be more encouraged to buy cars and houses and the like because they can buy these big things with a lower interest expense because the rate's lower, right? So if you think that's going to happen, why on earth would you buy a short-term bond? You're going to have to reinvest it into other bonds when it comes due, and the rates are going to be lower in the future. So why would you buy a short-term bond? You're going to want to buy medium and longer-term bonds, which then drives up the price of those bonds, which then reduces the amount that you get paid as a result of holding those bonds. Therefore, the yield goes down, right? You got to remember that there's this inverse relationship between the yields and the price of the bonds. So the short-term bonds, as less people want to buy them, the price goes down. When the price goes down, that means the amount that you get paid back as a result of holding the bond goes up, and therefore the yield as well. Now, the really interesting thing is that you are currently, well, depending on how well this video ages, you are currently living through history. We are in the longest period of yield curve inversion in history. It's been inverted for over 2 years now, since July of 2022. It's been inverted for so long that financial professionals are starting to say, well, maybe it's broken. Which, in all reality, though, let's be real, if there's one thing that financial professionals are good at, it's being wrong, myself included. But it makes you wonder. On July 24th, we had a day where the S&P 500 was down over 2%. And people were saying, it's Tesla earnings, it's Google earnings. But you kind of wonder if eventually maybe this isn't different this time. maybe this is how it actually is. Maybe we're finally seeing the yield curve catch up to reality, and this recession that the government and the Fed has been putting off for so long. Some argue since even 2008, 2012. Some argue that a big recession, that the great financial crisis should have been much bigger, but it was this quantitative easing that was done by the Fed that kind of prevented it, and that we're all living on borrowed time economically, so to speak. But who really knows? At the end of the day, nobody knows. The yield curve is a great predictor of recession. It had a false positive once. Maybe this time is different. Thanks for watching Venrate on YouTube. Be sure to check out venrate.com if you want to find out how much money you'd have left if the stock market went down 5% per year for 20 years. Be sure to check out venrate.com for the world's best financial calculators and planning tools. And have a good day.